Good. Thank you, everyone, for having me. Excited to be back in Singapore. My wife and I are planning to move our kids here in the next couple of months. We were here all of June and July, and it was extremely hot. And when we got here today, I was confused. I was like, what's going on? Like, the weather's not as bad as I imagined. So I'm hoping that I get many more days like today and many less like we had in June and July. As Steve mentioned, I am one of the partners at Bay Street Hospitality. We are a investment firm that built a platform for institutional allocators who are looking to deploy into the hospitality category. Institutional investors typically deploy less than 2% of their capital into hospitality, and that's because it's a very complicated asset class. With me, I have my partner, Tommy Lai. He's the former CEO at GHM, which owned the Chetty brand. Tommy is here today. We also have Katie Wei. She's out of New York. She was an executive director at AQR. That's a large quant hedge fund based in Connecticut. Manas, he ran all of foreign direct investment for India at Invest India. Managed several $billion of transaction of capital coming into the country. He and I worked together for several years in our pursuit of deploying in India before he joined the team. And then we've got Ken Heyman, who will be in Singapore later next month in October for HiCap. Now, in terms of where we are today, Bay Street Capital started out as a wealth management firm where we were quant investors for families that were in the public equity space. So our success when we sold that business in 2024, we decided to look at applying this into another category. And we settled on hospitality for a couple of reasons. One, unlike certain parts of commercial real estate, there's lots of ways and lots of levers that you can pull in hospitality to increase the return, both on the yield and at the exit, that you can't do in other types of commercial real estate. So for example, you can uplift a asset by changing the brand in hospitality. That's not something you can typically do in multifamily or in apartments or in industrial. Just changing the brand doesn't lead to a higher return from a yield standpoint. There's also a lot of mispricing opportunities in the hospitality space. And there's also a lot of biases that happen in the hospitality space because a lot of investment goes based on hubris or the desire to own an asset. It's not typically done from a data-driven standpoint. So what I'll be showing today is our approach to investing in the hospitality space. It's a bit academic, but it's also, in my view, very straightforward. So I'm an engineer by background. I went to Georgia Tech. I come from 4 generations of parents and grandparents and great-grandparents that were teachers. And so I was sort of groomed to take education seriously. And when we were running Bay Street Capital Holdings, one of the things that we would tell all of our new clients is that we don't allow you to invest in things that you don't understand. So my hope is after this, all of you will understand when you're looking at assets in the hospitality space, how you should be thinking about these investments as it relates to if it's deserving of your capital. Yeah. So the first thing that we're going to go through is something called the Sharpe ratio. This was done by a guy named William Sharpe. And all this is doing is telling you from a risk-adjusted rate of return, what is the best investment that you can make at a portfolio level. So that orange line that you see is something called the efficiency frontier. And when you're deploying capital, as you would imagine, you'd want to sit on the efficiency frontier at the most optimal place where you can get the highest return with the least amount of risk. Where you see that blue line, that's called your risk-free rate. That blue line where it meets that orange line, that is your optimal portfolio. So at Bay Street, we run something called a VCC. It's a fund structure that's based here in Singapore. And the overall portfolio is designed to sit on that efficiency frontier and be optimized for an investor. How that ends up manifesting itself is certain investments can be more income driven and certain investments can be more growth oriented depending on the market. The next is alpha. What alpha is additional return without additional unit of risk. So if you see both of these dots, the blue dot is not returning alpha. The red dot is. The reason for that is if you look at the x-axis, the beta, The red dot has less risks and it has a higher return relative to the risk that it has, whereas the blue dot has more risk and it has less return. In the hospitality space, alpha is very hindered by something called illiquidity, because when you make an investment, your capital is tied up. It is not like the public market where you can buy a stock today and then sell it 10 minutes later. And so what we look at is illiquidity and something that we call an illiquidity premium. That premium can express itself in things like seasonality, delays in the construction. It can express itself in things like trends that are happening from a construction standpoint. The next thing that we'll go through is illiquidity stress. What this is, if anyone's familiar with banking, there's a term called value at risk. And in that, what you're trying to determine is, in the worst case scenario, what is going to happen if everything goes terrible. When things go terrible, what is the maximum amount of money that I could lose? That is that grayish area. That grayish area is meant to show you, 95% of the time, things are going to go well. That would be the integral sign that you see there. But 5% of the time, things could go poorly, right? And when that happens, how poorly could they go? You're trying to identify over several iterations what would that look like, right, on average. And then the last thing, we put all this together for something called a base score. And all this is doing is it's taking the sum of all of the things that we care about, and then you're adding all of that up to come up with something that we can understand very simply. This is scoring from a 0 to a 100. And as you would imagine, it's just like school. So, 90 to 100 is a good investment. 80 to 90 is decent. 70 to like 80 is typically what you see in the public markets. And as you see on the right side of the screen, we take a lot of public market data and then we translate that over to the private equivalent. So in the public market, all of this data is available. So for example, you could look at something like a PE ratio. In the private markets, you could look at something like the price of the asset and then the 12 months trailing revenue. And then you could see, how does that asset compare to something that you could also invest in the public market. Now, what this ends up doing for an investor is you can look at a developer or an asset owner or an operator, and you could say, does it make sense for me to deploy my capital into this illiquid asset? Because now I can understand how to quantify that illiquidity. Or should I just buy Marriott stock, right? Because Marriott's going to return me 10, 11% a year. I'll receive a 1.5% distribution. And if I want income, I could just buy, the Host REIT, which is 70 Marriotts, and that's going to pay me an 11% yield, and I can sell the stock tomorrow. All of a sudden, when you look at a developer deal that's paying a 9% yield, you really have to ask yourself, is that worth my capital, right? There has to be much more upside from an exit standpoint. And then you have to determine, is this going to happen at the right time, or will it be delayed and eat into my yield from an IRR standpoint? Last thing we track is something called a hospitality index. Before we did this, there wasn't one particular index that a hotel investor could use to track what was going on in the market on a global level. So we took 8 different indexes and then we equal weighted them, really to be able to identify, if we're investing in developers, operators, or asset owners, what is the benchmark on a global level, so that as we identify particular regions, we can understand how these investments are working relative to their peer group and relative to the global market. Yeah. So what ends up happening when you put all this together, instead of just looking at an asset and then saying, how much is the total capital and what is the expected return on the pro forma, you'd ask more sophisticated questions. So you would ask a question like, does this beat the benchmark after the illiquidity? You'd ask, what is the exit path? What is the market risk, the currency risk, the repatriation risk, the foreign exchange risk, and how do I quantify that and then make sure that I'm being paid an appropriate amount in the investment relative to these risks that are going to be in this asset class? What happens if the exit gets delayed? And then am I being paid enough for the volatility in that investment? I'm going to go through a couple of investments where this has worked. We used to say what these companies were, but we were asked by some of the sponsors to keep it confidential, and you'll see why in a second. So here's an example. I'm going to go through one asset light. Asset light just means operator. The operators don't own the hotel. So the Westin is a brand. They don't own the asset. A group like Pontiac might own the physical asset here, and then they will hire the Marriott. The Marriott will brand this as a Westin. A asset light group is an operator. This particular operator has 170 hotels in 120 different countries, about 40,000 keys. Their EBITDA has doubled over the last 2 years. They are asset light, and they will IPO in the next 18 to 24 months. The majority of our asset light investments look like this, where we're the capital that comes in before the larger liquidity event, right? For this particular investment, we really like it because the group that we're buying it from is a non-strategic investor. They had bank capital come in. It's the only hospitality asset on the bank's books, and the bank does not want to wait for the later exit. There's one other blue chip investor, it's a large hotel group. They already own 60% of the business, and they're going to crystallize that investment by IPOing the brand, right? The next is we work with developers. A common structure for developers is 50-50 in JV. This particular investor is in developers in Portugal. We also have another developer that we're working with in Australia. Typically, these are also sort of based on structure. So for this particular deal, is through the Golden Visa program. Just for comparison, in the U.S., there's 20,000 private funds. In Portugal, there's only 40. So we're one of 40 funds that accredited investors choose if they're looking for a visa. When investors make that decision, it's not based on return, it's based on them wanting a visa. And so what ends up happening, we build these hotels. At the time of the completion, they receive the hotel room. In order to get a visa in Portugal, you have to put in 500k euros. We spend 125 of that, 125k to build the room. The rest of it is upside. So when you see that multiple of invested capital, the second line, MOIC, the 2.5x is actually an immediate 2.5x. We're not having to wait for the asset to get built because, again, the investors that are putting their capital into this particular fund are not doing that for a financial return. They're doing it for the visa, and what they receive at the completion is the room itself. And then Hilton pays them fractionally a share of the revenue when someone is renting the room. Then the next is a real asset. This one is actually a group listed on the Singapore exchange. This is a family that owns hotels in Singapore, in Australia, and in London. The patriarch is getting older, and they are looking for a succession plan. It's another sort of common circumstance for us. We're working with fourth and fifth generation families. This is a bit more work because they have several assets. They're not hospitality, so we'll have to sell off some of that. But it's also very attractive because, as some of you might know, the Singapore market is a bit illiquid compared to other markets. And so the family is holding a little over 80%. The minority investors are stuck. It's extremely illiquid. And so the minority investors will get squeezed out because they just want to be able to get out of the investment. It's trading at about a third of the NAV, and so a traditional bank wouldn't touch it, whereas a hospitality investor would understand, what would be a compelling offer for the family, and how can we make money taking this off of the public market and then making it a private asset and putting it into the portfolio. Yeah. So with that, I'm going to jump into the platform, and this is why this is why I asked them to let me share the screen, because typically I just take screenshots of this stuff. But I thought it would be helpful for you to be able to see, how are we using this platform to aggregate data and then understand why is one particular investment in one particular region better than another, right? So recall on the previous screen, I mentioned an index. So when you log into our platform, the first thing that you see is that index. So those dotted lines, those are the 8 benchmarks and how they've been performing year to date, right? You'll notice if I were to zoom in a bit that this says 8.7%. Yeah. So that's what's happened so far if you were to just take the benchmark on average. And when you're looking at the portfolio that we manage, we would say track our performance to this index because it's not the S&P, it's not NASDAQ. These are just assets, developers, and operators. And our view is that this solid gold line is a more appropriate benchmark to what we're doing. If I scroll down a bit, you can see the scoring logic that I spoke to. This just shows, like, when you see the numbers that are coming up, the formula that is being used to calculate the scores that we see, so that you can understand where the math is. When we click on these values, everything is referenced back to itself. That confidential deal that I shared, we also model out everything. So if I click on financial model, That particular transaction is a 405 million euro transaction. If I were to zoom in a bit, because it's still kind of small, yeah? Okay. So we're getting this asset at a 53% discount on current valuation. The business is based about 6.3 billion. Uh, we expect that it will exit around 7 billion. And what we've done is, instead of being forced to use like an Excel sheet, we allow the user to play with various scenarios when they can say, well, if we're wrong and it doesn't IPO at this $7 billion price point, what happens if it IPOs closer to the 6.3 billion that it's currently valued at today? That means that my internal rate of return would be closer to 15%. Or what happens if, this IPO takes longer, or what if it takes less time? How is that going to affect my internal rate of return? Another thing that we do that I think is extremely helpful, in the hospitality space, none of the data rooms look the same. All the performers are different. All the feasibility studies are different. What our platform does is it takes all of that and it shows it in a way and references each file so that you can see where the numbers come from. So in this particular transaction, if you were to look at the investment memorandum, that EBITDA of 78 million euros is on the investment memorandum on page 10, right? And then any projections, you can see that this section is editable. And then we also allow the stress testing, where you can say, what's the base case, the bull case, the bear market? And then what happens again if something gets delayed? How is this going to affect my internal rate of return at the exit? Yep. Now, I also, for the purpose of this demo, I'm going to show Singapore because I think it's helpful. But in real life, what we're doing is we're comparing these markets to all markets. This data right here is being pulled in from a platform called CoStar. CoStar acquired a group called STR. And so what you're looking at here, let's say, again, we use that example of the private family that's the family that's publicly traded in Singapore. We can see the occupancy in Singapore is up 2% year over year. That's sort of right here. My head's blocking it. The ADR, which is the average daily rate of these assets, is down 2% year over year in Singapore. And the revenue per room is about flat, right? We can also see the number of new rooms that have been delivered. We can also see projection for keys that are currently under construction. And so when we're looking at markets and we make a statement like it's more appropriate for us to invest in one country versus another, it's not like intuition or an assumption. It's actual data pointing to what's going on at a macro level before we make an investment into a particular developer, asset owner, or operator. Yeah. So if I come back up, the last thing that I'll show is often investors come to us and they say, hey, we were brought this opportunity. What do you think about it? Right. And so what we're able to do is either manually input this deal or upload it. All of this basically pulls from databases. We use a Snowflake database, and we also use some Google databases. So it's just displaying it in one place for an investor to be able to absorb the information and make informed decisions. And it's looking at disparate data points that are not necessarily intuitive. So for example, in that base score, if I show you this scoring logic, right, I mentioned that you'll be able to click and then see how an investment opportunity is being scored. And our view is that it's helpful to be able to understand what's actually happening when we say one investment is better than another. And the reason why we built this platform is because we wanted to be able to make sure that investors were able to understand from a data-driven standpoint why one particular hospitality investment was more desirable than another, without relying on, I was introduced to this developer, or, my friend knows this particular operator, or I like the way that this hotel presents itself. We saw that a lot of the decision-making was more I will say it was less data-driven than we would have preferred. And that's what led to us going from what started out as a very large Excel sheet to consolidating down to a platform that would help an investor determine where to deploy their next dollar. Yeah. So with that, I will say thank you and appreciate Wholesale Investor allowing me to show the platform today. And for anyone who wants to continue, looking forward to speaking later. Yeah, thank you.